Hey, right now we're taking a look at itemized deductions. Specifically something I see people misunderstand all the time. When I talk to them, they don't understand what an itemized deduction is and don't even really realize that it's an accounting term. Like, it literally is an accounting term. It applies to your Schedule A and your taxes. And we're gonna look right now what you need to be paying attention to if you're gonna do this on your own. So I'm pulling up Schedule A here, and very critically, I want you to look at this top left here, circled in black now. When we talk itemized deductions, we're talking about your Schedule A. Again, there's a lot of terms people will use when I ask them what they think itemized deductions are. I've heard business deductions, I've heard stuff associated with capital gains, like bonkers answers. What you have to know is that, again, this is an official tax term and it applies to your Schedule A, itemized deductions Schedule A. Now, what control do you have over your Schedule A? Really, we're looking at 4. And honestly, I could trim it down to, for a lot of people, 3 components that you need to be keyed in on. Now, right now, I'm gonna circle the 4 categories that you should be paying attention to. And really, these are the 4 you have to measure against what is called the standard deduction to see if you can even take any of these deductions at all. And the 4 you need to pay attention to are medical and dental, taxes you paid, interest you paid, and gifts to charity. For a huge majority of people, that's gonna be it. Those are the 4 things you need to be considering. And let me show you right off the bat why there's really only 3. Medical and dental expenses. We have this key term right here, 7.5%. And what this means is 7.5% of your AGI. So if your AGI, adjusted gross income, is $100,000, 7.5% of that is $7,500. If you spent $7,501 on out-of-pocket medical expenses, you would get to put $1 of a deduction on your itemized deductions. The same threshold applies if you're married as well. So you can see very quickly, how do you even get to that point? You have to spend a lot on medical expenses that aren't related to your premiums, that aren't related to anything that came out of your HSA. You don't get to take those here. They have to literally come out of your pocket and not be paid for in any tax advantage way. Since most people can't reach this, that's why there's 3. So now we're looking at taxes, interest, and gifts to charity. Taxes you paid, simple. It's gonna be state and local taxes, but really, you're limited to $10,000. So right away, for most people, if you're even looking at itemized deductions, you can assume what you're gonna get for the taxes you paid bucket is $10,000. Now, interest paid, typically, and we're gonna keep it simple here, it's gonna be home mortgage interest. So when you get your 1098 form at the end of the year, what you're gonna be looking for is the interest on there, the mortgage interest you paid through your escrow. For this example, let's just assume that was $12,000. And the last bucket we have to consider are gifts to charity. This gets really confusing, especially with people with businesses. What they will do is have donations from the personal, have donations from the business, not realizing that this is where they get incorporated a lot of the time. And essentially, if you're not meeting these thresholds and surpassing the standard deduction, your charitable donations are not getting deducted on your taxes, even though you may think they are, unless you see the details. For this example, let's just assume you made $5,000 in charitable contributions in 2024. That brings you to a total of $27,000 in deductions here. In 2024, the standard deduction for a married couple is $29,200. In this case, you did not surpass the standard deduction with your itemized deduction. So while you're still gonna get the standard deduction, the deductions you thought you were getting that end up on this itemized schedule are not gonna get taken on your taxes. Now, of course, this all changes if these numbers were to surpass that $29,200. In that case, you would essentially get a larger deduction for every dollar you cross that threshold. So if this amounted to $30,000 in itemized deductions, your deduction would be $30,000 on your taxes instead of the $29,200. These are where itemized deductions end up on your taxes almost all the time. There are a few circumstances where these can end up in different spots if you have a very specific situation, but almost all the time, for most people, this is where they're gonna be at. And you need to understand how this all works together if you're going to do your own tax planning. Otherwise, things like this are gonna fall through the cracks.